to your Monday Futures Market Outlook for April 11th, 2011. This is Patrick Ceresna. For those that have not had the opportunity to try out the eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles the market has gone through. Back in 2009 going into 2010, we bullishly crossed above that 80-week moving average, and the market has remained bullish since. At this, we were off of that summer low in 2010. We were looking for a market rally that should last up towards the 1350 to 1400 area, and really we've already achieved those upside targets in some form or another. While we certainly do not want to rule out the possibility this market maintains its upwards trend even for another month or more, at some point in the second quarter we're anticipating a topping formation that may very well play out perfectly with the sell in May and go away time horizon. And going into that second quarter, we're looking for selling to roll over into the third quarter with some more dramatic selling that could probably even see the S&P drop even 200 S&P points during a very robust market consolidation. We do not necessarily believe that that will be the beginning of a new bear market, but rather simply the process the market uses within its within a rally and a subsequent profit-taking cycle. We want to make some key intermarket observations from our analysis. We remain intermediate bullish on the market, but we have already reached our upside targets for the year, so it's sort of a give or take. We don't see the bearish trend beginning yet, but so right now staying with the upside trend is the only thing there, but there's only limited upside. The US dollar weakness with the breakdown we'll talk about in a second one and look at the charts. With the breakdown on the US dollar is keeping the existing trend in place for indices, commodities, and bonds. So we're anticipating some sort of a market top on the S&P 500 to develop somewhere in this 1340 to 1380 area, and there is a measured move that even goes as high as 1400 on the upside. Until the S&P breaks currently above this 1340 level where we just rolled off of, we have to at least not discount the possibility that we see a double top develop on the S&P and roll over from there. But we still actually at this moment favor the idea that the S&P still has one more leg higher to go up into that 1340 1380 zone. But if we keep projecting off at 1340, we have to consider the possibility that a double top could develop. Beyond that, just like we were saying earlier, we believe that the overall topping process should happen right now in the second quarter, most likely in this April-May cycle, and a full sell cycle will emerge going into the third quarter of the year. Here, when we take a look at the S&P 500 on the daily charts, you can see that double top risk that we've been talking about there in the previous slide. If we suddenly had an S&P that rolled over here, especially if given a catalyst to do so, could very well roll off the top here and start a robust sell cycle. But we don't favor that scenario. The more likely scenario is that even if we have a sell-off down towards the 1300 level where that support line lays, we still believe the market should roll up and attempt to make highs, higher highs up into this 1340, 1380 area. Again, there is a measured move that even goes as high as 1400, but usually in a topping formation, the market does not complete a full measured move higher. So 1400 is only the most optimistic of scenarios. More likely, it'll be a shortened push higher up into that blue box. Next year, when we take a look at that NASDAQ 100, that we drew a blue line roughly where the stalling is occurring at the same time as the S&P is testing its previous highs. We've seen predominant weakness in NASDAQ stocks and technology stocks over the industrials and other sectors that have been performing very well. Right now, that's interesting because the NASDAQ has really been the leadership of the major part of the rally, and we're really seeing them lose that leadership role. and that question becomes then is where does the leadership come for a market to push to another level? It certainly does not look like it's coming from financials. So so long as the commodity cycle keeps going, then a lot of these commodity and industrial stocks can act as that leadership. But really, as less and less sectors are rallying, it will start solidifying market tops. Nonetheless, if the S&P does break to a higher high, the Nasdaq could definitely come back for a solid retest of the 2400 or even push as high as 2450. But we don't see much more upside on the Nasdaq. Next year, I'm going to take a look at that US dollar index, and this is where much of the intermarket bullishness is coming from in so many other areas. The US dollar continues to deteriorate and has actually broken to a lower low from its low from the month of March. With this breakdown, if it sticks, the US dollar can easily work its way down to the 75, 74 level, even as deep as 73 on the downside. Overall, though, we do believe the US dollar will hit a bottom down here. This is not necessarily a brand new shorting opportunity. As the US dollar deteriorates down into these levels, it probably will represent a very good period to be accumulating US dollars, but it is very early to start talking about that. We may spend another week or two or even a month or more with the US dollar basing and finding levels down at these lower zones as to where it could roll up from. In the bigger picture, the shift that we're talking about has to predominantly come from a US dollar bottom and then subsequently commodities selling and bonds rallying. And so right now, with the US dollar breaking down, it at least gives us an indication that this is not underway yet, and that we have to let things still base out for the month of April and probably into the month of May before we can see a bigger rotation. Next year, I want to take a look at copper futures, and copper, just as that dollar broke down, bullishly broke out off of that trend line we had drawn even last week. Really, that was one sort of big flagging consolidation at this juncture. So long as the US dollar weakness becomes a predominant trend over the next couple of weeks, it's quite possible that copper will make a push that can test even 480 to 500 on the upside. That should bode well for a lot of these base metal stocks during this cycle. But really, that 480 to 500 was our upside target for the year on copper, and we'd not be expecting much more strength beyond testing of those zones. Next year, we're going to take a look at gold futures, and gold bullishly broke out. We had that flag, but it's more like an ascending triangle that's been forming along that 1440 level. We were saying that with a bullish break on the upside, gold we'd have our initial targets up at this 1480 level, which was pretty much tested on Friday. But we also have some bigger measured moves that measure even as high as the 1530, 1550 area on the upside. Also, the 1500 round number right up above should draw some sort of attention, or at least stall the market on some short term. Overall, gold at this point has broken out. So long as US dollar weakness is in trend, then continuing strengthening gold prices and silver prices is the path of least resistance. At some juncture, gold and silver will put some sort of a major top in this year, but there's no indication of a topping formation yet. And so at this point, don't stand in the path of this trend. Next year, I want to take a look at crude oil, and crude oil had that very bullish breakout. We drew that flagging formation in a couple weeks ago. Said any break above that 105, 106 level opens that window for a move all the way to the 115 to 120 area. We started off the week with a strong bullish break and follow through up towards the 112, 113. Really, at this stage, there's nothing standing in the way of crude oil from finishing its measured move up to 115 to 120. We really are looking for bigger picture tops up in that zone, but when you have a very strong momentum push like we've seen in crude oil, really at this stage, even in the 115, 120 area, we would not be prepared to start short selling it or anything like that. Just a very prudent level to start considering profit taking on your crude oil positions and subsequently oil stocks. Really, as we see crude oil rally up there, we'll consider any number of scenarios that could even have crude oil push a little bit higher. But in the bigger picture, once that dollar bottoms out over the next couple weeks or months, we're going to be looking for major tops in crude oil as well. But really, at this stage, again, just like we were saying with gold, you don't want to stand in the path of this. This thing is very distinctly moving higher and with momentum. Finally, I want to take a look at the 30-year Treasury notes, and we had a sort of an attempted bullish breakout on the upside of those Treasuries, but with that US dollar breakdown and subsequent strength in commodities, which it puts inflationary fears in place, Treasury bonds have started to weaken again. We're at a major level where all these lows occurred. If Treasury bonds break this zone, it's quite possible that we see Treasury bonds even weaken down toward 116 or 114 on the downside. Overall, in the much bigger picture, we think that there'll be very big bottoms on the 30-year Treasury notes down along these lows. But I think that again, it's a little early to have be looking for that at this juncture, at this stage with the weakness that's developing in here. We probably are still heading lower before we can see a bottoming formation develop here. That was your Monday Futures Market Outlook. Thank you for joining me.